Hello, I'm Ilaria Maselli. I'm a senior economist at the Conference Board, and I'm the moderator of this webcast by the title Thriving in the Eye of the Brexit Storm. Very timely. As a good moderator, I'm going to share with you some tips on how to best enjoy this hour. So you can ask questions. There is a chat box at the bottom left of your screen, and I very much encourage you to do so because it makes our webcast even more interesting. You can download the presentation, and we're happy if you share it with your colleagues. You can also watch this webcast later. In a few hours, this will be available on demand, and if you enjoy spending time with us and you want to recommend the content to one of your colleagues, please don't hesitate to share the link. We really appreciate if you dedicate to us the last minute of this webcast to fill in our evaluation form, because it helps us to improve our offerings. One more thing, you can earn credits by watching this webcast, but please note that these are available only if you watch them, if you watch the webcast live, and if you follow the entire program. Now, this said, I'm gonna introduce to you the virtual panel that we have today, my four speakers. I'm gonna start with Fergal O'Brien. He's the Chief Economist and Policy Director at IBEC, an Irish business association. Hi, Fergal. How are you? How is it in Dublin today?
Good afternoon, Ilaria, and good afternoon, everyone on the webcast. Looking forward to talking to you all over the next hour or so.
Thank you. Thank you for being with us today. I'm going to switch to Robert Bedford. He's an economist at Robert Bosch, and also is sitting today in Germany, but he's also a British man, so I'm sure he's following this developments on many grounds. Hi, Robert. How are you doing?
Good afternoon, Ilaria. Good afternoon, morning, everyone. Yes, indeed, I am an Englishman in Germany and on tenterhooks for the next 39 plus days. But looking forward to discussing that this afternoon.
Thank you, Robert. I'm here sitting next to me, Matt Hind. Thank you, Matt, for joining live here in the studio and sitting with us.
Thanks very much. I look forward to the discussion.
Welcome. And finally, my colleague Klaas de Vries, Associate Economist here at the Conference Board, who is going to share with us some of our findings related to this research.
Glad to be here, Ilaria.
All right. So what are we going to talk about? I'll just give you a brief outline of our discussion. We're going to start with the most recent update to make sure that everyone is on the same page with the latest development. For people in Brussels like us, this is breakfast every morning. But maybe not for everyone, so we're gonna start with the recent updates. Then we're gonna switch to the impact of Brexit on the economy, and we will focus on the UK, Ireland, and the Netherlands. The two latter countries are the ones that are closest, of course, to the UK in terms of commercial ties. Then we're gonna focus more on the impact of Brexit on business decisions, including in the manufacturing sector. We will hear a lot here from Robert, and how this is perceived in Germany at Bosch. Then I'm going to ask everyone to answer my question. Is there any upside that we're not considering? Because every time we talk about Brexit, we only look at the negative impact of this shock, but maybe there is something good that can come out of this, hopefully. And then, if we have time, we will also talk about other policy-related risks in Europe. This is a bit of a new thing. We thought policy risk was something of emerging markets until a couple of years ago, and now we are living a lot of turbulent situations. So we're going to talk a little bit about Italy and France. So this is our outline for the rest of the hour, but now let's go into it with the recent updates. Matt, do you want us to work out through what is happening?
Sure, thanks very much, Ilaria. I will just run through briefly where we've got to at the end of, well, almost the end of the Article 50 process, and where the real problems are for the British government at this point in time. I mean, we're now, well, as Robert previously mentioned, 39 days away from Brexit Day.
Who's counting?
Well, probably a lot of people should have been counting when they triggered Article 50. We've got an agreement. It was agreed in November. It includes a withdrawal agreement, the divorce, a transitional, which ideally would keep us in a status quo situation until the end of 2020 or the end of 2022. And we've got a pretty vague political declaration on the future future relationship. Um, Prime Minister May took that to the House of Commons in early or mid-January, and she lost by 230 votes. And 230 votes is the biggest loss for a government on a serious issue of policy in parliamentary history. Not a great start. Then in early February, May came back to the House of Commons and accepted something called the Brady Amendment, which was basically an instruction from the House, as she interpreted it, to come back to Brussels and reopen the withdrawal agreement. This is difficult for a number of reasons. One is it has probably fundamentally damaged her credibility with the EU27. May had agreed the withdrawal agreement and the political declaration, and for the perception is she has disavowed that agreement by signing up to this Brady Amendment. And she's come back to Brussels seeking three things. One, a time limit or one of three things: a time limit on the backstop for Northern Ireland and Ireland, a unilateral exit mechanism for the backstop, or an ability to use alternative measures as opposed to the backstop. And just to remind everyone of what the backstop is, it's in essence an insurance policy to ensure that there is no need for a hard border between the Republic of Ireland and Northern Ireland. And due to UK pressure, not just between the Northern Ireland and the Republic of Ireland, between the Republic of Ireland and the whole UK. And so to that extent, from a European perspective, you cannot have a unilateral end to it. You cannot have a time limit, because then it's not an insurance policy. So this isn't going to work as far as we can see.
And this was really the main reason why the agreement was rejected by the British Parliament.
Certainly it was one of the reasons, and this is the problem, but it's not just one reason for the rejection. For the Tory Eurosceptics, the perception is the backstop traps them within regulatory alignment with the European Union forever. Not necessarily true, but their perception is that. But for a lot of Labour Party MPs, the problem is the political declaration is simply too vague. It's a blind Brexit. There's no guarantees of a future relationship. So the problem is, the EU's perspective is it was such a large defeat that the perspective here is that if they moved on the backstop, for example, it would be no guarantee that she would still get it through the House of Commons. And for the EU to move on the backstop would be a significant step down. So they're not going to do that unless they know that May has a stable majority in the House of Parliament. The next key date's the 27th of February, when the government will come back to the House of Parliament, and there is the potential for something that is called the Cooper-Letwin Amendment, which would effectively, if it was to win, would force the government to ask for an extension of Article 50, and would provide space for Parliament to try and coerce the government, in essence, into a different route to try and get an agreement. It's unknown how likely that is to happen, and I'll just touch on this now, because of the politics in both the Labour Party and the Conservative Party, this is all completely unclear. The Labour Party split yesterday for the first time in 30 years, 7 MPs left. Now, it was partially about Brexit, partially about some other issues with the Labour leadership. But one of the issues here is the leader of the Labour Party, Jeremy Corbyn, has always been a Brexiteer. So he nominally voted Remain in the referendum, but he's always been Eurosceptic. And it's a reasonable assumption to say that actually he wants Brexit to happen, but he doesn't want to be associated with it. So it has to be a Conservative Brexit, but probably the only way that Brexit can get through at the moment is with Labour Party votes. You have the Tories, who have a hard core of 60 MPs who I think you could describe as no-dealers, the European Research Group under Jacob Rees-Mogg, who actively want no deal because they don't want what they see as being bound into European regulations. And you have the Democratic Unionists, the 10 MPs from Northern Ireland who are keeping the Conservatives in power. On top of that, you've got 30 pro-European Conservative MPs who have told Theresa May yesterday, apparently, that if she actively seeks a no-deal outcome or doesn't do enough to avoid it, they will resign, which could well bring down the government. All of this is to say that what we're seeing here is a fracturing of the British political system that I don't think we've seen in living memory. And so actually understanding what will happen and what will happen in 39 days is completely unclear at this point in time.
Thank you so much for the recap, Matt.
So we talked a little bit about the backstop being a big issue here, but what about the rest of the withdrawal agreement? There was also a lot of criticism about just a broader agreement, right?
Yeah, I mean, I think it's the main criticism of the broader agreement is, I mean, there are complaints from the Eurosceptic side about the 39 billion in liabilities, the Brexit bill as it's described. But I mean, most people accept that that is liabilities that the UK owes from commitments we've signed up to. The main complaint, really, as I mentioned, is around the political declaration on a future relationship, because it's very vague. It doesn't really nail down anything. There's a paragraph in it that says the future relationship will be based on a combination of rights and obligations. Well, that's what it said at the start of the Article 50 process. There's lots of nice language in there about, close relationships with the single market. But fundamentally, British red lines in terms of the four freedoms, and specifically the priority, which is for Theresa May at least, stopping freedom of movement, means that a closer relationship with the single market isn't possible. But that's not where the Labour Party is, for example, or pro-European Conservatives.
I see.
Thank you for the brief, efficient recap, Matt. What I think is fascinating is that we would have imagined when Article 50 was triggered that by now we would have some sort of clarity on where we should be with 39 days from the big Brexit day, and still this is very, very much unclear. So I want to launch a poll and survey the audience and the virtual panel here on where we think we're going to be in the next, on March 30, when we wake up. I don't see the poll on my screen. I hope you can see it. Yes, okay, so I'm going to read it. On March 30, we will wake up with the UK, A, still in the EU due to an extension of Article 50 deadline, B, trading with the EU under WTO rules, meaning a hard Brexit, or C, out of the EU but covered by the Prime Minister May agreement. So I'm going to wait a couple of minutes, and then I'm going to, yes, please, you also vote. My speakers here, you should also vote. I'm going to wait 20 seconds, and then I'm going to ask Matt and Fergal to comment on the result. Okay. So we have here a clear majority of 100% of our audience that believes that there will be an extension of Article 50 deadline. Matt, what do you think about this?
I think that's the central scenario, to be perfectly honest.
Okay, so
I don't see any chance of us leaving with a deal by 29th of March, because there will have to be an extension. It's not just voting for the deal, it's voting for all of the supporting legislation, trade bills, customs bills. There's an enormous number of secondary legislation that needs to be put through the House of Commons as well, and nothing's happening at the moment. So if she gets a deal, and she could get a deal at the last moment before 29th of March, it would still have to be extended. But there is still an uncomfortably high chance of a no deal as well.
Which is what I wanted to vote for, except I had problems here with the iPad. But my vote was for, to me, the most likely scenario is the hardest Brexit. So, Fergal, what do you think? What did you vote? Okay, I don't hear Fergal, but in this case, I'm going to move to the next slide and get Fergal back, because we're going to talk about the Irish economy very soon. So I'm moving here to the next slide because I want to talk about the impact of Brexit on the economy first. And let's start with the British economy because it's in the middle of the fire. Klaus, we did some estimates in our last iteration of the Global Economic Outlook model. Do you want us, can you drive us through this estimate?
Sure. So I think before we move on to discuss the coming 10 years, I think it's worth mentioning that there have been a lot of estimates already that since the referendum in 2016, there has already been a loss in GDP. Now, of course, a lot of this is what-if scenarios. I mean, you can never for sure know what caused what, but there seem to be a lot of estimates floating around that a lot of income loss. This morning I read one estimate of £800 million a week since the referendum was already lost because of the uncertainty. We'll talk a little bit more about where that is coming from. But now moving on to what we project for the next 10 years. So just a quick background. We have this Global Economic Outlook model where we project for most most of the individual economies in the world economy. We project the GDP by looking at the supply side indicators. So we look at the historical relationship of a number of relevant variables that drive productivity, that drive capital and labor growth. And so as you can see on the slide, we have two scenarios here. So the blue line is the business as usual scenario, and as this is a supply side model, we really look at the long term. So it's really the endpoints that you should look at here, not so much the movement in between. So our base case scenario is for about 1.3, 1.4% GDP growth for the next 10 years, which I should mention is already a little bit on the low side if you compare it to other organizations like IMF or private forecasters. Now what we did is we sort of shocked the model a little bit. As I said, we have a supply side model where we have these explanatory variables. So for example, we have R&D as a factor explaining productivity. We have ICT capital deepening, corruption. We have a number of variables, so we can sort of play around with the assumptions for future values of those variables, and then see how that impacts the factors, and then finally how it impacts GDP. So for hard Brexit, and we'll discuss in the end a little bit more of a positive upsides, but for this exercise, we took a very hard line. We really decreased R&D. In terms of labor input, we put migration to 0, so that obviously has a big impact on labor input, and so forth. We had a couple of iterations, and what we found here is that that has the potential to slow GDP growth to 0.8%. Annual growth, as opposed to the base case of 1.3%. So that, running through the numbers, that arrives you at about $3,000 per person per year of income loss, based on this model.
Thank you, Klaas. Matt, how do you see this estimate? Is it very strict, not strict enough? What do you think?
I mean, I think it's probably broadly in line with other estimates. I mean, I think I'd note one thing, which is the assumption of zero migration. I don't think that will happen, because I think the British economy would probably collapse if you did stop migration like that. And it's one of the ironies of this is that, if you look at seasonal workers in the hospitality sector, 75% of hospitality workers in London are EEA nationals. I think in the rest of the country it's 65%. So I think they will have to find a way of maintaining some level of migration into the economy, both highly skilled and lower skilled. I mean, the thing I notice here is the job losses in the UK up to 500,000. Now, I mean, personally speaking, I don't think you can see how that could happen. It's just worth noting one of the major things that's happened has been the resilience of the jobs market in the UK since the referendum. And in some ways, it's damaged the arguments from the latent Remain calls that there has been no real noticeable uplift in unemployment since the referendum. And the flexibility of the British labour market, and also probably an encouragement of kind of less secure jobs, has led to that. But I mean, that would be the thing I would just flag, is that the UK labour market has been remarkably resilient since 2016, even in the face of quite strong headwinds. So I wonder what will happen with that, but I don't fundamentally disagree with the analysis.
Yeah. Well, what we've seen so far, and maybe we'll talk a little bit more, is that the economy has been slowing down, but a lot of people predicted that there would be a big drop, and that has not happened. And as you mentioned, the labor market has been especially resilient. Of course, to the detriment of productivity growth, which has I think it's currently at almost 0%. So, but yeah, good point about immigration.
There is one variable actually in the labor market that we have seen changing very rapidly, although from very low levels. That's why it keeps being neglected and doesn't make any headline, and that's the unemployment claims. So if you look at normally the unemployment rate is a lagging indicator, so it only starts moving after 9 months from a recession. So I think it's quite a reasonable outcome at this stage that there is no recession, that the labor market is still in decent shape. But there is one variable in the labor market, perhaps the only one variable in the labor market that is a leading indicator, and that's the number of people claiming unemployment benefits. Now, there is not many because the unemployment rate is as low as ever since the 60s probably. But this has been increasing very rapidly, and it's actually one of the three indicators of
The
our
unemployment claims. Sorry.
the unemployment
Yeah,
claims.
yeah.
Thank you, class. So this is one of the three variables in our leading economic index that you can see here in this chart that has been increasing since the referendum, and the other two are well, consumer confidence that has been going down, and indicators related to the housing market. So there are these three variables in our leading economic index that have been really shifted the index down and led us after summer to call for a very high risk of recession upcoming in the UK. And one thing I would like to make clear to this in this discussion is that, okay, there is Brexit, and this is of course a huge risk for all the reasons that we're talking about today, and otherwise we wouldn't be talking about it today. But there is also a very mature business cycle, and the two things are coming together, and that's what makes the risk of recession potentially very, very painful. Now, what everyone wonders, of course, is, okay, it's quite clear that there will be an impact on the UK, more or less strong according to different estimates, but it's quite clear that there will be an impact. But the question is, what is the impact of the Brexit shock in other European economies? And what we have here on this chart, and I'm going to ask class to explain it, is a bit of a Brexit pain thermometer. So can you explain to us what it is, class?
Sure. So one way of measuring the exposure to the UK would be to use the direct exports from country A to the UK. But downside of using that is that a lot of the export, especially for a country like Netherlands or Belgium, which have large harbors, is that a lot of those exports are simply re-exports, or they don't contain a lot of value that is added within the country itself. So what we do here instead in this chart is look at that part of GDP that is consumed either by business or by consumers in the UK. So you could see this, and then we present it here as relative to the whole economy. So that's also the reason why you see the smaller open economies, well, the Netherlands is not that small, but you see the smaller open economies more to they have a higher percentage because of course they are more open towards foreign trade. Now, and I should also mention here that this can be anything. So if the Netherlands, for example, a Dutch automotive company produces parts that goes to the German automotive sector, and then Germany exports it to the UK, that is also included in these numbers. So it's pretty comprehensive measure. And I think what clearly stands out here is that the Netherlands, Belgium, and Ireland, of course, but also the Eastern European countries, they are very, very exposed to consumption in the UK. So this is a measure of downstream exposure, so to say.
Which also gives an idea of why we decided to focus on Ireland first of all, and then the Netherlands as well. Because if I get it, I hear some return in my earpod. So 74%, and correct me, class, if I'm wrong, of GDP in Ireland comes from demand in the UK.
7.4.
7.4.
Yeah, so you have like...
And 3.4 in the Netherlands.
Yeah, so you have probably 40% is consumed in Ireland itself, of Irish GDP. The rest is foreign, and out of that, a large part is based in the UK.
Okay, so this gives a very nice way to then switch and focus on Ireland. So, Fergal, what do you expect the impact of Brexit to be on the Irish economy? I cannot hear you. I don't know if anyone else can.
I think you're muted.
Now, just testing again there that we're coming across. Okay, Ilaria, unfortunately our connection dropped.
Okay.
Hopefully you're hearing and seeing me okay now.
Yes, I hear you now. So tell us, what's going to be the impact of Brexit on the Irish economy?
Yeah. It is going to be a net negative for the Irish economy. I think there's no question about that. I think what's quite interesting in the context of Ireland is that our business model has evolved significantly over the past 20 or 30 years. And we really have become a hub of globalization now. So it's actually very difficult to be a macroeconomist in Ireland because it's incredibly challenging to try and interpret how the different cycles and the different segments of the economy are evolving at any one time. So what we see is very much a kind of a global economic sector, predominantly in high technology, in the digital sector, in the biopharma sector, in medical devices. And to a large degree, that sector of the economy most likely will not be impacted by Brexit in any kind of significant way. But then we see the more traditional sectors of the economy, such as agri-food, such as traditional manufacturing. And for them, the UK remains by far the most important export market and will be very, very significantly impacted. So it's interesting, given the evolution of the Irish economy over the last number of years, the degree to which it has become this global hub for multinational business, we see a lot of corporates will not be directly impacted by either the European economy or specifically what's happening in the UK. So the UK actually is no longer Ireland's largest trading partner. The US is now our largest trading partner, but significantly the UK has a larger determinant, the most significant determinant on employment, because the type of companies that are trading with the UK tend to be more job intensive, labor intensive. So again, going back to the kind of multipliers and the linkages you see across agri-food, the food processing sector, agriculture, and traditional manufacturing. So what happens to the UK will matter a lot for the Irish economy, not as much as it would have in previous years or previous decades because of this sophistication, this evolution, and this hyper-globalization essentially that we've seen in Ireland in the last number of years. If you look at how GDP is performing in Ireland, we are facing the Brexit challenges from a very significant position of strength. So really, we've experienced very, very strong GDP growth now, probably since about 2013, 2014, as we've come out of the Great Recession. All of the domestic sectors and the export sectors of the Irish economy performing very, very strongly. And we've pretty much been at the top of the European chart in terms of GDP performance for the last 4 or 5 years. We don't have final numbers yet for 2018, but there has been no discernible impact of Brexit in our GDP numbers over the past 2 years or so since the vote. It looks like we're going to see some combination of some capacity pressures because the economy is now back at full employment, the impact of a slowing European economy, and some growth pressures emerging in the US will lead to slowdown in Ireland in this year. Our forecast, the IBEC forecast of a 4% GDP growth, would be very much predicated on having either an extension or having a deal agreed during 2019. We haven't modeled a no-deal scenario, but our estimation and drawing on the work of other forecasts of the Irish economy looks like it would take in the region of 1 to 2 percentage points of GDP off that 4% GDP growth forecast for 2019. So not enough to push us into recession, because I think we'll see those other sectors of the economy and the globalized sectors of the Irish economy that I spoke about continuing to grow very strongly. We still have a lot of momentum coming through in terms of domestic sectors such as construction and consumer spending, but we would see significant risk to that 4% economic outlook in 2019 if we have a no-deal cliff edge scenario.
Fergal, I'll just repeat to make sure that I understood it correctly. So your expected growth rate for GDP in 2019 for this year, it's 4.1%, and in case of no-deal Brexit, it would be 1% lower than that, more or less. Did I get it right?
Yeah, I think that's a fair summation, Ilaria. It is very, very hard to model the scenarios at the moment in terms of the type of risks that we're facing in terms of disruption to manufacture, to supply chains. The biggest risk clearly will be a weaker UK economy and a weaker European economy. And that will come through to the Irish numbers, but we still, even in the worst case scenario, we do not expect Brexit to push the Irish economy into recession because the momentum is so incredibly strong and because of the hyper-globalization that we're seeing, particularly in the high-tech sectors of the economy. One of the features of the last number of years has been our employment growth again has been right at the top of the European charts. I'm just showing there the numbers over the last 12 months. And you can see that some of our sectors are very much still in that catch-up phase, particularly construction. So we're growing construction employment in the region of 15%. And we just have some more recent observations actually out this morning that show that construction employment is now growing by over 20%. So there's still quite a lot of momentum in terms of normalization from the Great Recession coming through in the Irish economy, and those international sectors performing very, very well. We do expect to see a slowdown in that employment growth this year because we are essentially now back at full employment, and a lot of future employment growth will depend on our ability to attract mobile labour into the economy, and we need to be able to absorb immigration in terms of having sufficient housing and work permits in terms of immigration from outside the EU. But that labour market is an incredibly strong position.
Okay, I see. And what about consumer expectations?
Consumer expectations, again, have been dented. We see consumer spending is still really, really strong. So the reality of the consumer fundamentals is very solid. We've seen disposable household income growing by between 4 and 5% each year over a period of about 5 years. We've had zero inflation in the Irish economy for more than half a decade. So consumers really have been having quite a bonanza in terms of employment growth, wage growth, some modest tax reductions, and their disposable income has been very, very strong. But sentiment has been on the wane. That has not translated to a weakening of consumer spending, either in retail or other sectors of the economy. But clearly, one of the very significant threats that we would face almost immediately in the event of a cliff edge exit would be our exchange rate challenge. So again, the UK, as such an important trading partner for Ireland, typically our exporters will tell us that if they're in that kind of 90p to euro range in terms of the exchange rate, that's probably the pressure point for Irish exporters. Prior to the vote, we had probably a lot of stability in terms of that relationship in the currency relationship. Right now, you know, at around the level that it's at, exporters are able to bear it. We've been looking at obviously the Bank of England forecast that could take us to £1.10 to the euro, and that would be beyond the point of pain for Irish exporters. So that's probably one of the key indicators that we're going to be looking at in terms of immediate threats to the Irish economy come the end of March in terms of the various scenarios that we're going to be mapping out in terms of deal or no deal.
All right, I see. This was a very clear overview of the impact of the relatively low impact, given the situation of the Brexit shock on the Irish economy. I'm actually pleased to hear that the supply constraints are actually a stronger drag on the economy, perhaps, than Brexit could be, because that's a lot of our research focus on the supply side of growth and productivity, and so I'm sure we have a lot more to exchange on this. But I'm conscious about the time passing, and I'm going to briefly mention something about the Netherlands, because as you saw in the pain thermometer chart that we presented 10 minutes ago, the Netherlands is the second country that is most exposed to the Brexit shock in Europe. And there is an interesting study, if you want to read the details, if anyone online has a particular interest in the Netherlands. There is a recent OECD study that really outlines the risks, but also the upside. And one issue that they focus on is the sectorial exposures, and they really show how the sector that is most exposed is the agri-food sector, where the export from the Netherlands to the UK are huge. It was what, 17% of the entire export is in that sector, and this is a sector where, in case of hard Brexit, there would be high tariffs because just the WTO tariffs are very high on agri-food, and this would have, of course, a relatively important impact. However, recent estimates from the Central Planning Bureau of the Netherlands show that, again, a little bit like in the Netherlands, a very hard Brexit, so something estimated in the range, something that would halve the trade between the UK and the Netherlands, would cut growth by 1%. So instead of being 2.2% this year, it would be 1.2%. So a bit like in the Netherlands, it would be a relatively important shock, but not enough to push the country in a recession. As I said, if you're interested in the Netherlands, I really recommend this study because it explains quite clearly all the channels for the Brexit shock. I would like to move now to the second part of this discussion, which is the impact of Brexit, not only on the economy in general, as we discussed so far, but really on business decisions. And in our internal discussions, we were trying to unpack that, and we have outlined 6 possible ways for the Brexit shock to materialize and to have an impact on business decision. And one of them, of course, has to do with the uncertainty related to the situation and the investment decisions of companies. And we have a chart here, Klaas. Could you explain what we have here in this chart that is related to investment?
Yeah, sure. So we have the nominal investment of non-financial corporations here, which is a chart that is often shown in relation to what we already talked about, the uncertainty since the referendum had already had a material impact on the economic situation in the UK, and one of the key indicators here is the investment data. That is, as you can see, we compared it here to a couple of European countries, but also if you compare it to other mature markets like the US or mature Asian markets, the UK is definitely lagging behind here, and that is despite that their ongoing expansion has been relatively good so far. There is high business profitability. Financial conditions have been pretty accommodative, so those factors make it even more surprising. So, as I said, compared to the peers, but also compared to their own history in terms of the UK business investment has been very weak.
Thank you, Klaas. Matt, we can really see this in the data that investment has been weak. Is this the only impact? Is it the strongest impact? How do you see it at the British Chamber of Commerce?
I mean, I think this is the strongest impact is on investment at this point in time. But I mean, it derives from both political and economic uncertainty. On the one hand, one of the reasons that the British economy has been fairly robust in recent decades is because it's been one of those countries where there has been a great deal of regulatory certainty. Successive governments who have all broadly taken the same approach in terms of kind of marginal increases in competitiveness and efficiency and productivity as being the kind of the key driver. That's kind of going to a certain extent, as we see with that political fragmentation. But I mean, also there's the uncertainty of what trading regime is everyone going to be in on the 30th of March. I mean, ships are leaving Japan and the Far East now, destined for the UK, and it is no longer clear what trading regime they will be under, which FTA they will be under when they arrive, and vice versa. I mean, we're looking at, if you look at the chemical sector, for example, is the UK chemical sector going to be covered by the REACH regulation? Are the product licenses that have been established in the UK for the last 10 years still going to be valid on the 1st of April? It's unknown, frankly, at this point in time. And that level of uncertainty, I think, is the major kind of consequence at the moment, and that's hitting investment. Because in the end, why would you make a decision to invest apart from non-discretionary investment in the UK at the moment?
Good question. Is there anything else that you see in the behavior of businesses that is visible and that it is related to Brexit, besides the decision of postponing or changing investment or making investment outside the UK perhaps, but certainly not in the UK?
I mean, I think that, as I say, the investment's been the major thing. I think what you're seeing now in terms of there is a increasingly long list of companies that are changing their operations or moving certain numbers of jobs or people out to the rest of the EU or to elsewhere in the world. And I mean, I think you've seen that in the financial services sector with a variety of banks who have moved to Dublin, Frankfurt, Paris. You'll see a great deal with the automotive manufacturing sector. I mean, and that's a very specific issue around the Japanese companies, which obviously came. Why were there a lot of Japanese automotive companies in the UK? Effectively because of the UK's positioning as the entry point to the single market, as encouraged by the Thatcher government in the 80s. And you've seen the memo from the Japanese government in October 2016, which was, I think, 18 pages of arguments as to why the UK should not leave the single market and the customs union, which sadly does appear to have been completely ignored by the British government. And to a certain extent, you're seeing the consequences of that at this point in time.
And is there anything, because I mean, in order to move your operations, you have to be a relatively big company, I mean, a certain size. Do you see anything among small businesses?
I mean, I think the major impact on small businesses is the supply chain impact. And I think you're seeing it today with Honda, for example. Now, Honda may or may not have been about Brexit, and the company itself has said it wasn't, and it was more about global impacts on the automotive sector. But, you know, it's 3,500 jobs lost in the plant, 3 times that hit by the impact on the supply chain, and that applies across the board in the UK.
So the local suppliers of Honda.
Exactly, and I think you see the same thing with Nissan, the same thing potentially with the other companies who will be hit by this. I mean, the other issue, of course, is those SMEs are the ones that perhaps have not been trading with anyone outside of the EU. For the big companies, there will be experience within the systems of, you know, customs forms, you know, just the mechanisms for third country exporting and importing. If you're an SME who's been part of the supply chain for products that are going just into the EU, you don't have that experience. I think that's where one of the potential shocks really is at the beginning of April. So hopefully the government is doing as much as it can to help people in that situation, though I think there's a question there.
Yeah, that's a very important insight, because perhaps there are some small companies that 40 years ago did used to do that, but those people might have retired and no one knows how to fill in a custom form anymore. So that's a very interesting insight. Fergal, I'm going to ask the same question to you. What do you see business behavior changing as a result of this uncertainty, and if yes, how?
Yeah, and I think it probably goes back to the earlier comments, Ilaria, about trends across the different sectors of the economy. When we look at most of the macro data, we're not really observing much. So like investment is at a record level, so business investment has never been stronger, but that's been driven by technology, by the high-tech sectors of the economy. Just showing the chart there in terms of SME lending. And there are some signs there that the SME sector that's most likely to be exposed to Brexit risks, that they are pulling in the horns a little. They are concerned around some investment decisions. We've also observed it in some key hires in business. So in terms of taking on particularly senior hires, companies that might be looking at a kind of a major strategic shift, they're putting some of those decisions on hold. So we don't see much in the macro data. When we go beneath the surface and the kind of observations that we have across IBEC with all of the different sectors of the Irish economy that we work with, we can definitely see some of those experiences. In terms of what companies have been doing, the main response has been around stock levels. So we've seen large numbers of our companies at this stage have been carrying higher stock levels, either for their customers in the UK, where we've seen companies procuring additional warehousing capacity for stock take, or also in their supply chain into the Irish operations. We're seeing companies carrying higher stock where they can in kind of non-perishable sectors. And that's obviously costing business a lot of money. So there's no question that when the vote didn't go ahead in December, that was probably the key flag for a lot of companies to put contingency plans into action. They've responded in terms of some supply chain changes. So we have seen companies adjusting their supply chain models in terms of where they're securing supplies from, more significantly in terms of the stock that they're holding, both for their customers in the UK and for their Irish supply chain process in terms of stock levels in Ireland.
Now, speaking of supply chain, Robert, you've been very quiet, and I really want to hear from you. You are seeing this from very close, how the just-in-time approach is at risk. So do you want to give us an overview of the automotive sector and what you expect to be the impact?
I'll give you a few slides. The advantage or disadvantage of being towards the end is that most of the other guys have very kindly set out most of the arguments. So thank you very much. Just slide 19 to have a different access to the slides. So I'm on the 19th slide. Just an overview of the German auto sector, just to show a little bit of context for automotive manufacturing in Germany, obviously related to a lot of our customers in the UK and worldwide, showing this massive reduction in production, new orders from the middle of 2018, impressive rebound at the end of the year, but it's largely temporary, and the fact that the various uncertainties in the global economy have definitely had an impact across the board in Germany. If I just go to the next one, just to show a little bit of background as to why we think that this is only a temporary rebound in the auto sector. Here we've got some sentiment indices for global manufacturing in total, plus automotive and machinery is obviously something that the Bosch, of course, are interested in. This is from markets that we get the sectoral indices, showing that both automotive, which has been on a downward trend basically since the beginning of 2018, but obviously recently machinery as well on a global scale, have moved below the neutral 50 mark, signaling obviously there's something afoot, that the global outlook is not that rosy. Moving on to the next slide, 21, here we're focusing on the components of the global PMI, again from market, showing where this weakness is coming from. Global output is held up mainly by the US, but most of the other sectors, the other regions are falling, particularly in terms of export orders are well into contractionary territory. New orders holding up a little bit, but export orders reflecting the various issues that is acting as headwinds. And the final slide, just to tie things up in terms of the auto sector, just to show the weakness across the board outside the US, in terms of the EU, Japan, and China. They are signaling definite weakness and have been doing so since certainly the second half of last year. So that's the kind of the background situation to German manufacturing and the auto sector that we're facing. Obviously, in all this mix is the Brexit. Obviously, for us, that we see that very closely. We are the leading tier one supplier. Obviously, most of our customers are either exporting or producing and selling in the UK, and we're seeing that as one of the major impacts there. Obviously, also the trade disputes with the US is trying to change the rules of the game, looking at China and also, but also looking at the EU. Obviously, the auto sector in the in the firing line, and also the slowdown in China, which we believe is a lot stronger than the official numbers are showing. If we look at the auto sector itself, here we're seeing a lot of spillover effects from all these headwinds, plus some idiosyncrasies or firm-specific effects. We got JLR, which we see as in the eye of a perfect storm. We have the Brexit issue regarding access to potential future access to European markets from supplying from the UK, together with slowdown in China, issues in terms of JLR's particular quality issues in China, and the way that that's been communicated and reflected in pricing strategies and obviously write-downs in Chinese market. Ford, of course, have had its issues regarding suggestions on engineering and its engine production in the UK. We've heard about Honda, of course. Honda, of course, was probably the weakest of the three Japanese manufacturers in the UK. Had been reducing capacity, or had its capacity reduced in the UK as capacity of above 250,000, I think, units per year, but which since the great financial crisis has been only at about 150,000. One model, and of course the Brexit is a perfect excuse not to not to renew the Civic, and of course with the FTA with Japan and EU, they probably is cheaper to supply, potentially cheaper to supply the new Civic from Japan directly into the EU in the next 5 to 10 years than it is from the UK. So there's quite a few things happening there. How is the sector reacting? We've heard about regarding some of the job announcements, some of the product announcements, and we've seen that in terms of probably lack of investment also going on. We don't hear about that too much, but you can see it. I think Matt showed one or two of the slides regarding nominal investment, which has been very weak since about 2015-16 onwards, and obviously we're seeing that in the auto sector. In terms of I'll just move along a little quickly. In terms of the actual Brexit itself, of course, auto supplier very closely tied in. It's probably one of the most joined up sectors in manufacturing. Very tight lines in terms of just-in-time supply chains, toing and froing across the channel. Obviously, task forces across the board in terms of how we react to a kind of Brexit that we still don't know what kind of Brexit we're going to react to. So building up of production in anticipation of bottlenecks after 29th of March. So it's obviously additional costs in terms of stocks, warehousing. We have transport emergency scenarios in case of problems at bottlenecks at ports, air freight instead for certain commodities. That's obviously additional costs there. Things that people don't really talk about, but be mentioned, I think, by Matt, in terms of the fact that the UK had benefited for 20, 30 years from being a good place to do business. Very, very stable regulatory environment. That, of course, could all disappear overnight virtually. So things like invoicing, IT issues regarding master data, VAT invoices. They, of course, were formerly, UK still is under the EU VAT regime. That might change or will change, and how will we join that up later? The whole idea regarding cross-border deliveries, additional staff required. We've got experts and brokers on the case. IT processes need to be fine-tuned. A lot of it will be go live on the 29th of March, so we really no idea how this is all going to work out. Other aspects regarding directive conformity, there are all kinds of wording going backwards and forwards as to whether this will be okay or not, but personal related data of EU citizens must stay within the EU. Therefore, we have to look at how this will work out regarding where exactly we hold this data. Also, British citizens, including myself, having my data stored in Germany might not be possible anymore. HR related issues. There's a lot happening, all within a very short space of time under different scenarios that we don't know how serious some of this will be. That's the short-term impact. The longer-term impact, of course, is, well, how do we get to this stable realignment or stable agreement between the UK and EU? What will that look like? We're having now some of the impact on the auto sector in terms of companies probably have had enough and are adjusting accordingly. So what we would expect to see would be more for those companies like Mini, JLR, would be potentially moving more supply production facilities or hiring or licensing production facilities in the EU just simply to supply there. And we'll see that gradually happening over the next few years.
So, Robert, you must be working very late hours lately because there is a lot happening in the world. The momentum is down for the automotive sector, different shocks happening at the same time. Short term, very uncertain. So you have all sorts of different scenarios with different action points for each scenario. And then long term, even more uncertain. Okay, I don't envy you today.
And that's without saying anything regarding diesel or the end of ICE as well. So we have our work cut out at the moment.
Right. You are not getting bored for sure.
Not at all.
I would like to use the last 4 minutes of this webcast to ask a question to all of you. So you have about a minute each for this discussion. As I said at the beginning, I expected this webcast to be all about the negative impact, which is what we deeply discussed in this last 55 minutes. But what I would like to speculate a little bit, and I know it's very difficult, is whether there is any upside in this Brexit shock. And Klaas, you don't want to go first. It's a difficult question, I know, but let's try to be a little bit creative and think.
Sure, yeah. Like I said in the beginning, we tend to focus on the negatives, of course, but I think that there may be some upsides as well. I think on the short term, there's definitely going to be pain on all sides. But as you mentioned, Brexit does also present some opportunities to, especially for the UK, to change things. And I'm not saying it will happen, but it might produce an opportunity. For example, if you look at the structure of the UK economy has become really centered around London. It has become a little bit lopsided in that regard, also with regards to the financial sector. So Brexit might be a chance. Again, it might be a chance to break through that pattern and find a new development model in that sense. Now, another structural issue that I could think about is more general. What we see in I think globally is that there is a bit of a tension between the ongoing globalization and integration of markets that sort of supersede local democracy or local sovereignty. So again, here Brexit might present an opportunity to find a new model that is more balancing local and global demands. So I'll leave it with that.
All right, Matt?
I mean, I think in the short term, it's very difficult to see any upsides at all, frankly. In the medium to long term, I mean, it would seem to me that there's the potential for the UK to be actually a bit of an experiment. There is a chance that there will be quite a hard left government under Jeremy Corbyn, in which case you may well see an attempt of kind of socialism in one country in a developed economy, a much more kind of an economy that's run contrary to state aid policies, for example, that really does take quite an aggressive stance in terms of public investment and things like that, which will be interesting to see what the consequence of that would be. I mean, the alternative is that a continuation of a centre-right wing government, where probably their only option, and this is what a lot of the supporters of Brexit want as well, which is a very deregulatory model. Singapore on Thames has been quoted, but that may work as well. I mean, more specifically, there are issues where the EU has been quite cautionary in terms of its legislative frameworks, on the basis of the precautionary principle. And emerging technologies, emerging sectors like artificial intelligence, for example, continuation of genetically modified food, pushing the boundaries on that, perhaps there are opportunities. But I think it's medium to long term.
Right. Robert?
Here I would concur with Matt, particularly potentially the move along to AI and genetically modified foods, plus what Klaus was saying regarding the over-reliance on London. Again, medium long term, that would be probably the only areas I could see as positives. In terms of Europe, I could see more offshoring from UK to the European Union countries, particularly auto, machinery, chemicals, and those kind of cross-border businesses. So for Europe, it could be a little bit better after things settle down.
Okay, and last but not least, Fergal, do you see any upside?
Yeah, thanks, Hilaria. Mention three things very, very briefly. Firstly, when we get beyond Brexit, we're going to take a lot of uncertainty out of the system, and uncertainty really has been impacting on business in the UK and across Europe because of the Brexit issue over the last 24 months. So getting rid of uncertainty is actually a big upside in terms of our macroeconomic outlook, if we get a benign outcome. Secondly, I think it is going to spark some interesting issues in terms of the future of Europe debate. I think one of the things we're going to learn about our internal market and about the benefits of customs union is because, we built up those benefits over 2.5 decades, we probably didn't fully appreciate how significant they are. When we see those benefits extracted in the context of what might be a hard Brexit, then I think we will get to appreciate more what Europe can achieve. And I think we will have quite a different dynamic in terms of that future of Europe debate and discussion in terms of how Europe can add value for member states and for the wider population in all our countries, which I think will be very important. And thirdly, again, as was just said by Robert, I think countries such as Ireland clearly are getting some Brexit upsides. We are seeing relocation of financial and non-financial sector activity into the Irish economy, and that is offsetting to some degree what is a net negative experience in terms of the macroeconomic impact of Brexit from an Irish economy perspective.
Okay, thank you everyone for a lot of things, for the interesting insights that came out from this discussion, for sticking to the time. We're going to have to close, but you can read on the slides our projections for GDP growth, and you can download a publication that we wrote a month ago that is still very relevant. And if you have one last minute dedicated to us, we would appreciate if you could fill in the webcast evaluation. It helps us improving. So thanks a lot to the audience. Thanks a lot to my virtual panel. It's been a fantastic hour, and I hope you all enjoyed it.